Have you ever wondered what would happen if the price of silver suddenly skyrocketed? Not just a little jump, but a massive leap to over $100 an ounce. It sounds like something out of a financial thriller, but the story behind this possibility is more real than you might think. Let's rewind the clock a bit. Back in the late 1970s, two brothers, Nelson and William Hunt, believed that inflation was out of control and that paper money was losing its value. They saw silver, a tangible asset, as the ultimate safe haven. So they started buying. And they didn't just buy a few coins, they bought futures contracts, physical bullion, everything they could get their hands on. Their goal was to corner the market. As the Hunt brothers' buying frenzy intensified, the price of silver began to climb. It went from just a few dollars an ounce to 10, then 20, then 30. The world watched in astonishment. By early 1980, silver hit an unbelievable peak of nearly $50 an ounce. People were literally melting down their family silverware, their heirloom spoons and tea sets, just to cash in on the silver boom. It was chaos. But this massive price manipulation couldn't last forever. The commodity exchange and federal regulators got involved, changing the rules of the game to stop the hunts. They imposed limits on how many futures contracts one could own, essentially pulling the rug out from under them. The new rules created what's known as Silver Thursday. The price collapsed. The Hunt brothers, who had borrowed heavily to finance their silver hoard, were facing monumental losses. The market was in a panic, and the fallout was huge. The brothers eventually went bankrupt, and the silver market took decades to recover. This event serves as a powerful lesson in market dynamics, greed, and the immense power of both private investors and regulators. It showed the world just how volatile commodity markets can be and how quickly fortunes can be made and lost. So, could silver ever reach $100 an ounce again? Well, the world today is very different from the 1980s. The demand for silver isn't just for investment or jewelry anymore. It's a critical component in modern technology. Your smartphone, your laptop, solar panels, electric vehicles, they all need silver. It's one of the most conductive metals on Earth, and its industrial use is exploding. As we push for a greener, more technologically advanced future, the demand for silver is only set to increase. Unlike the Hunt brothers' artificial squeeze, this new demand is organic and sustainable. Now, let's talk about the supply side. Mining silver is a complex and expensive process. Many of the easiest to reach silver deposits have already been tapped. Plus, a significant portion of silver is mined as a byproduct of other metals like lead and zinc. So, its supply isn't always directly tied to its own price. When you combine this ever-increasing industrial demand with a potentially constrained supply, you get a classic economic recipe for a price surge. Some analysts believe it's not a matter of if silver will cross the $100 mark, but when. It wouldn't be due to a market corner this time, but due to fundamental global shifts in technology and energy. It's a fascinating story to watch unfold, one that connects our past with our technological future. Thanks for watching, and don't forget to subscribe for more deep dives into the world around us. Have you ever wondered what would happen if the price of silver suddenly went parabolic, smashing through the $100 mark? It's not just a wild fantasy for silver bugs. It's a scenario rooted in some serious and often overlooked stresses building up within our global financial system. Let's dive into what could trigger such a monumental move and what it would mean for all of us. For decades, silver has been seen as the poor man's gold, a monetary metal that's also a critical industrial component. Its price has always been volatile, but the forces that could propel it to triple-digit territory are bigger than ever before. We're talking about a perfect storm of factors, and it all starts with the staggering amount of debt in the world. Global debt levels are at all-time highs. Governments, corporations, and individuals are more leveraged than ever. Central banks have tried to manage this by keeping interest rates artificially low and printing unprecedented amounts of money. This strategy, known as quantitative easing, has kept the system afloat, but it's like a dam holding back a massive flood. The more money they print, the more the value of our currencies, like the dollar, erodes over time. This is where silver comes in. Unlike paper money, you can't just print more silver. It's a finite physical asset. Throughout history, when people lose faith in their currency, they flock to precious metals like gold and silver to protect their wealth. If confidence in the US dollar, the world's reserve currency, begins to wobble, we could see a massive rush into hard assets. Silver, being much more affordable than gold, would likely see an explosion in demand from everyday investors, trying to preserve their purchasing power. Then there's the industrial side of the equation. Silver is indispensable. It's in your phone, your laptop, solar panels, and electric vehicles. The green energy transition is incredibly silver intensive. As the world pushes for more solar energy and EVs, the demand for physical silver is set to skyrocket. Supply, however, is struggling to keep up. We're already seeing a structural deficit, meaning we're using more silver than we mine each year. This supply and demand imbalance alone is a powerful catalyst for higher prices. Now, imagine these two forces colliding. You have a tidal wave of investment demand driven by currency fears, crashing into a market already strained by soaring industrial consumption. That's the recipe for a historic price squeeze. Major financial institutions have been known to hold large, short positions in silver, betting on its price to stay low. A powerful surge in price could trigger a massive short squeeze, forcing them to buy back silver at any price to cover their losses, adding rocket fuel to the rally. So, what does a $100 silver price look like? It would be a clear signal that the financial system is under extreme duress. It would mean that inflation is likely running much hotter than official numbers suggest, and that trust in central banks is evaporating. For those holding physical silver, it would be a moment of significant wealth creation. For those holding only cash or bonds, it would be a painful wake-up call about the erosion of their savings. This isn't about predicting the future with certainty. It's about understanding the pressures building beneath the surface. The story of silver isn't just about a shiny metal. It's a story about debt, currency debasement, and the fundamental shift in our technological and financial worlds. Watching the silver price is like watching a barometer for the health of the entire global economy. The journey to $100 might be volatile, but the signs are pointing to a very interesting road ahead. What are your thoughts on this? Do you see silver as a critical asset for the future? Long before silver crossed $100, the conditions that made such a move inevitable were already in place. The price did not rise because something new suddenly appeared in the world. It rose because a long series of slow structural changes had finally reached a point where they could no longer be ignored. For most of the past decade, the silver market had been shaped by an illusion of abundance. On paper, supply always seemed sufficient, inventories existed in databases, contracts could always be rolled, delivery obligations could always be deferred. From the perspective of financial markets, silver looked like a well-supplied, liquid commodity. From the perspective of the physical world, the picture was very different. Mining is not a business that responds quickly to price signals. New projects take years to permit, finance, and develop. Ore grades across the industry have been declining for decades, which means more rock must be moved, more energy must be consumed, and more capital must be deployed just to maintain the same level of output. At the same time, environmental regulation, political risk, and financing costs have made large-scale mining projects increasingly difficult to justify. The result was predictable, but largely ignored. Global silver supply stagnated. In some years, production grew slightly. In others, it fell. But what never happened was the kind of sustained investment cycle that would have created meaningful spare capacity. The industry was being run for efficiency and cash flow, not for resilience. This would not have mattered if demand had remained stable. It did not. Over the same period, silver quietly became one of the most strategically important industrial inputs in the global economy. It is essential for photovoltaics. It is embedded in electronics, data centers, medical equipment, advanced defense systems, and high-efficiency power transmission. The very technologies that define modern economic growth are unusually silver-intensive. This created a structural change in demand, not speculative, not cyclical, but embedded in infrastructure. Unlike jewelry or investment bars, industrial demand does not disappear when prices rise. A manufacturer does not redesign an entire production process because one input becomes inconveniently expensive. In most cases, the metal is simply paid for because the alternative is to stop producing. This makes silver demand far less elastic than most financial models assume. While physical supply was becoming more constrained and industrial demand more rigid, the financial market for silver was expanding in the opposite direction. More contracts, more derivatives, more synthetic exposure, more ways to gain price exposure without ever touching the metal itself. This is not unique to silver. It is a feature of modern finance. But in silver, the imbalance became extreme. The ratio between paper claims and deliverable metal grew year after year. This was justified by the assumption that most participants were only interested in price exposure, not in settlement. As long as that assumption held, the system appeared stable. It was a system built not on metal, but on confidence. Central bank policy played an important, if indirect, role in reinforcing this structure. Years of ultra-low interest rates and repeated liquidity injections pushed investors further out on the risk curve. Commodities became financial assets. Financial assets became leveraged instruments. Leverage became normal. In such an environment, price signals lose some of their meaning. When capital is abundant and cheap, shortages can be masked by inventories, by futures curves, and by balance sheet capacity. The pressure builds quietly. For a long time, silver lagged behind gold and other hard assets. This reinforced the belief that it was plentiful, secondary, and non-critical. In reality, it was being consumed, not hoarded. Every year, a significant portion of global silver production is used in ways that make it uneconomic or impossible to recycle. The stock above ground does not grow the way it does with gold. This is a crucial distinction that was rarely reflected in market pricing. The commodities complex as a whole was also becoming more fragile. Supply chains were optimized for efficiency, not redundancy. Inventories were minimized. Logistics networks were stretched across continents. Energy costs became a critical variable in extraction, refining, and transportation. All of this worked as long as the world remained stable, predictable, and well-financed. But systems built this way do not fail at their weakest point. They fail at the point where stress concentrates. In silver, that stress accumulated at the intersection of three forces: constrained supply, inelastic industrial demand, and an overgrown financial superstructure of paper claims. The market could absorb this imbalance for years because price was not being forced to do the work of rationing. Instead, it was smoothed, managed, and stabilized by financial flows. The signal was muted. What changed was not the fundamentals. What changed was the tolerance of the system for ignoring them. As physical tightness became harder to hide, as regional price differences began to widen, and as delivery stress started to appear in subtle ways, the market was forced to begin the process of repricing. Not to reflect enthusiasm, but to enforce discipline. The move toward $100 did not begin as a speculative mania. It began as a search for equilibrium in a system that had been allowed to drift too far from physical reality. By the time most observers noticed, the process was already well advanced. The hidden pressure had not just built for years, it had been compounding. In today's financial markets, we're all obsessed with price. But what if I told you the price you see on the screen is just the tip of the iceberg? The real power, the hidden force that determines who wins, who loses, and who gets wiped out, is something else entirely: leverage. Imagine a world where silver, a metal we all know, suddenly skyrockets to $100 an ounce. The real drama isn't on the price charts. It's happening silently inside risk systems, margin models, and collateral schedules. This is where the global financial system truly gets tested. You see, the silver market is a complex web of interconnected players, all using leverage. Producers hedge their future output, refiners hedge their costs. Traders and funds use futures and options to gain exposure. Banks finance and manage all this risk. Each action makes perfect sense on its own. But together, they create a tightly wound network where a small price change can trigger a massive demand for cash. For years, this entire structure was built on the assumption that silver would trade within a familiar historical range. All the risk models, all the stress tests were based on this idea. But silver at $100 shatters those assumptions in an instant. Suddenly, a producer who sold their silver in advance to lock in a price is no longer just hedging. Their safe position has become a giant liability, demanding more and more cash just to maintain it. A market maker who sold options to collect a small, steady income is now staring into the abyss of catastrophic loss. This is the moment when conservative strategies transform into wild, speculative bets against your will. This brings us to the core mechanism: margin. Margin isn't a penalty. It's a safeguard to ensure promises are kept when prices move violently. But here's the fatal flaw. Margin systems are procyclical. They demand the most collateral precisely when it's hardest to find. As silver soars, clearinghouses and brokers hike their margin requirements. The effect is like a powerful vacuum, sucking capital out of the system faster than anyone anticipated. And that's how a liquidity crisis begins. It doesn't start with insolvency, where assets are worthless. It starts with timing. A fund doesn't fail because its investments are bad. It fails because it can't meet a cash call right now. A trader doesn't close a position because their idea was wrong. They close it because they've run out of capital to hold it. In a leveraged system, the sequence of who is forced to act first is everything. The first stage of this crisis is quiet. A few trading desks quietly reduce their risk. A few phone calls are made between risk managers. To the public, nothing seems to be happening. Then comes the second stage, the mechanical one. Volatility spikes, triggering automatic margin increases. Assets that have absolutely nothing to do with silver start getting sold off as players scramble to raise cash. This is the start of contagion. The problem is no longer just about silver. The third stage is a terrifying feedback loop. The rising price of silver forces those who bet against it to buy it back at any cost. This forced buying pushes the price even higher, which triggers more margin calls, which forces even more buying. The market is no longer driven by fundamentals or valuation. It's driven by the raw, brutal mechanics of balance sheet survival. What makes this scenario particularly dangerous is that many of the big players on the wrong side of this trade are not speculators. They are commercial producers, market makers, and institutions with complex, structured products. Their positions are deeply embedded in our economic supply chains and can't be unwound easily. When they are forced to act, they do so under extreme pressure, amplifying the shock waves. At the heart of all this are the clearinghouses. Their job is to prevent the system from collapsing, so they have to be extremely conservative. When they see volatility, they demand more margin. This puts more stress on participants, which makes the clearinghouse even more cautious. It's a rational response that, ironically, makes the whole system more fragile. The final accelerant is something called cross-margining. Big players post collateral for their entire portfolio, not just one asset. So a crisis in the silver market starts consuming the liquidity that was supporting positions in stocks, bonds, and everything else. This is why, in the early stages of a deleveraging event, everything seems to fall at once. The real connection isn't some grand story, it's the plumbing of the financial system. At this point, the system isn't just adjusting, it's fighting to survive. The most dangerous part isn't what people know, it's what they thought they knew. The risk models, the assumptions about market behavior, they all break down. And when they do, the cascade isn't gradual, it's sudden. In this world, silver at $100 wasn't just a price, it was the trigger. Have you ever wondered how a small fire in one corner of the financial market can suddenly engulf the entire system? It's a phenomenon that keeps regulators and investors up at night. Today, we're diving deep into how a seemingly isolated event, like a sharp rise in silver prices, can trigger a full-blown systemic crisis. It's not just about one asset, it's about a chain reaction that can shake the foundations of our financial world. So, let's start with our example, silver. Imagine a coordinated effort, perhaps fueled by online forums, drives a massive speculative rush into silver. The price skyrockets. On the surface, this might seem contained. It's just silver, right? But here's where the trouble begins. The first transmission channel is funding. Many financial institutions, like hedge funds, might have been short-selling silver, betting that its price would fall. When the price shoots up instead, they face massive losses. To cover these losses, they need cash, and fast. This leads to what's called a margin call. They have to post more collateral to back their losing bets. Where do they get this cash? They start selling other assets, stocks, bonds, anything they can liquidate quickly. This forced selling puts downward pressure on the prices of those other assets, spreading the stress from the silver market to the broader stock and bond markets. Suddenly, a problem that started in commodities is causing a stock market dip. This is the funding channel in action. Next, we have the confidence channel. Markets run on trust. When traders see a major fund scrambling to sell assets to cover a bad bet on silver, it creates panic. They start asking who else is exposed, which other big players are in trouble. This uncertainty erodes confidence across the board. Banks become hesitant to lend to each other because they don't know who might be on the verge of collapse. This is called a credit freeze. When credit dries up, the entire economy can grind to a halt. Businesses can't get loans to operate, and consumers can't get credit to spend. A loss of confidence is like a virus. It spreads quickly and can be incredibly destructive, turning a localized problem into a systemic threat. The third and perhaps most potent channel is the narrative. In the age of social media, stories spread like wildfire. The narrative around the silver squeeze might be framed as Main Street versus Wall Street, or a sign that the home system is rigged. This narrative can attract more and more retail investors to join the speculative frenzy, amplifying the initial price move and making the situation even more volatile. On the flip side, it can also fuel the panic narrative among institutional investors. They start seeing ghosts in every corner of the market, questioning the stability of everything. This battle of narratives can create extreme volatility and unpredictable market behavior, making it incredibly difficult for anyone to make rational decisions. The story becomes more powerful than the underlying financial fundamentals. Now, let's tie it all together. Our silver price shock started a domino effect. The funding channel forced distressed firms to sell good assets, depressing their prices. The confidence channel caused a credit crunch as fear spread. And the narrative channel amplified both the speculation and the panic. This is how a localized stress test morphs into a systemic crisis. It's not just one thing, it's the interplay between these different channels. Regulators are keenly aware of these transmission mechanisms. That's why they implement measures like circuit breakers to halt trading during extreme volatility and conduct stress tests to see how banks would hold up in such scenarios. They try to build firewalls to prevent the blaze from spreading. But as markets become more interconnected and information travels faster than ever, the risk of a small spark causing a massive explosion remains very real. Understanding these channels, funding, confidence, and narrative, is crucial for any investor. It helps you see the bigger picture and understand that no market is an island. What happens in a niche commodity market today could impact your stock portfolio tomorrow. It teaches us to look beyond the headlines and analyze the hidden connections that wire our global financial system together. So next time you see a dramatic price surge in an obscure asset, don't just dismiss it. Ask yourself, what are the potential chain reactions? How could this ripple through the system? Because in finance, everything is connected. Thanks for watching. If you found this breakdown helpful, be sure to hit that like button and subscribe. For more deep dives into the world of finance, let me know in the comments what other financial topics you'd like to see explained. Stay curious, and I'll see you in the next video.